Good day guys, welcome to Chartered Accountants video tutorials. My name is Tapiwa and today we're going to be dealing with the revision of CTA 1 2019 mid-year exams. Well, so today we're going to be dealing with required B. Required B required us to prepare a memo addressed to PTG's Management Executive Committee in which you calculate the amount in dollars that PTGS should pay for 60% equity in BHC Limited. When necessary, provide supporting explanations. Part 2 required us to discuss other matters that PTGS should consider before deciding on the acquisition of BHC. Okay, so on this required, as an exam tip, you must try to answer these questions concurrently or simultaneously. For example, when you're doing your calculations, there are some points that can just jump up to you or in your mind, and then you quickly write them on the required 2 part. So, what was the first thing we need to do in order to calculate, in order to answer required B? So, we asked to do a memo format. So, what does a memo do? A memo, the correct format is to, from, date, and subject. This is the correct memo format. Where you're asked to do a memo format, please do a memo format. Most students do not present the answer in a memo format, which meant you hurriedly went to calculate and skip the requirement of the solution to be in memo format. This was an easy 1 mark, ladies and gentlemen. Wherever you get a memo, make sure you present your answer in a memo format. Okay, if we move on to the calculations, I'm just going to do the calculations here. So we asked to do, obviously, with the information that we had. Let's go and see where the acquisition of BHC. We had revenue here, we had gross profit, we had net profit. Okay, so what do you want to do? The further information that we were given that revenue is to grow by 15%, and then gross profit is to decrease, and then net profit after tax to grow by 15%. At the end of the day, all we want is a free cash flow method, since it is the most appropriate method in this case. If you want to acquire a 60% controlling interest, the dividend growth model will not be very much useful in this case. And also, the information that we are given is leading us to a free cash flow valuation rather than a dividend growth or a market based. So we're going to be using the free cash flow. And from a free cash flow point of view, is it easier to start from revenue or is it easier to start from net profit after tax? A clever student will start from net profit after tax, as from net profit, if you just remove your non-cash items, then you have a cash flow. Rather than if you start from revenue, you don't know the cost of sales, you don't know whether there is other income, you don't know whether there is the expenses, how much were there, how much were cash, or how much were in credit, something like that. So we're going to start from net profit after tax. And most of you failed to realize that the free cash flow valuation method needed to start from net profit after tax and not revenue, given the lack of information. And the possible reason why is you did not apply yourselves to what you wanted to do. In this case, you wanted to come up with a free cash flow. The designed outcome, but rather applied principles of a similar question that you did during practice. Maybe when you did your practice questions, they were starting from revenue. So most of you started from revenue, which was wrong. Okay, so if you start from net profit, we're just going to do our adjustment. So let me just go to our working sheet. So we are saying we have net profit after tax, and then on our years, how many years do we have? We're given up to for the next 4 years. Currently, we are in 2018, so we have 2019, 20, 20, 20, 21, 2022. So these are our years that we're going to be using. And for the representative year, as for the terminal value, it's going to be 2023, since we're given that revenue is from 2023 onwards. Is expected to grow by how much? Okay, so On the growth side, net profit, we're just supposed to grow it by 15%. After we grow it, and from 2023 onwards, we're going to grow it by 6% in order to calculate the terminal value. You also showed, also on doing these calculations, most of you showed poor exam technique is you lost consequential marks. Wherever you're doing the calculation, make sure you follow through each and every figure where you're supposed to go. For example, if you used a wrong 15%, is in the wrong calculation. For you to do the growth, maybe we said 0.15 in error instead of 1.15. If you grew the revenue by 0.15 instead of 1.15, we're just supposed to take that incorrect figure and place it where in our calculations here. Whether it was wrong or not, there are some consequential marks that you just get as you be doing the question. So we have grown our net profit by 1.15%, and then for the terminal value, it's going to be 1.06, which is year 2023, right? And then what's the next adjustment that we should do? If we go back to our scenario, we're going to see that there are these notes. Since we won't be using revenue, we won't be using gross profit, note 3 is the one that's going to help us answer or do our adjustments. So we have depreciation, and depreciation is 800 and expected to increase at 3%. So depreciation, is it a cash item or a non-cash item? So you know that it's a non-cash item. We're just going to add it back since it was subtracted before. And should we subtract it net of tax or after tax? Since we are adjusting net profit after tax, and depreciation does not have any tax consequences, we're just going to adjust the whole amount 800 without subtracting or adding tax. Confirm? And also we're told that the working capital replacement, if we're saying replacement, what does it mean? Replacement means that the working capital that we need is 10%. It's not the working capital change, it's the working capital that is required. So on the working capital replacement, it's going to be 10%. And how do you adjust for that? Just say 10% of annual revenue. And which annual revenue is this? It's the adjusted revenue that has been grown by 15%. These were just easy marks, guys. And whether you get these figures wrong or correct, they were consequential marks whether you do the adjustments. If you go to the dividend income is from prop properties. Does prop properties have the same risk profile as BHC? And the answer is no. So we have to value this dividend or this investment separately. And on valuing separately, you were told that the dividend for the next 4 years is going to grow by 4% and thereafter stabilize at 3%, which means you have to use a two-tier dividend growth model, which we have the cash flows from 2019 to 2023, and then we grow by 3% from 2023 going onwards. And then you're going to discount with what? The cost of equity, which was then 30%. After we get this value, what should we do with it? We should add it to the enterprise value. Most students, you failed to do this. You calculated the dividend, but you didn't add it to the enterprise value, which was wrong. Also, some students added back depreciation and deducted dividends after tax, but there are no tax implications in these line items. For example, if you go to the where is the note? Dividends are not tax deductible in Botswana. So when you are adjusting adjusting our net profit after tax, let's just go. So right here we added back depreciation, and then on the dividends, since it was added, we are going to subtract it since we need to separately valued, right? So since we are going to subtract this one, we are going to subtract it is 100%, not net of tax. Why? Because dividends do not have any tax implications. And then if we go back to our note 3 here, we're told that interest expense is 600 and it's expected to be redeemable in 4 years time, coupon. With this information, can you confirm that you can use your IRR method to calculate the present value, of which in this case your N here was 4, your PMT was 10% of 6 million, and then your future value was 6 million. With this information, you can calculate your what? Your present value here. So in this case, and what should we do? What's the correct adjustment for this interest expense? Since interest is included in our work entails cost. Work we're saying is cost of equity plus cost of debt, and then this one is average, right? So the weighted average cost of capital includes cost of debt. Thus, we have to interest expense, we have to add it back, and then you need to state your reason included in work, right? And then when you're adding back, we're told that it's 800 here, it's 600 I mean, but does this 600 have any tax consequences? Yes, it does. So a clever student, if you're not sure, you just add it back 100% here, right? And then you say tax adjustment on interest, and then you put the adjustment here for the interest where you subtract the tax adjustment here. Simple, guys. This is an exam technique. Make sure you use it wisely and do not just add the interest just like that. So after this, we're going to get our net cash flows. After we get our net cash flows here, we needed to add back the terminal value. Which terminal value? I'm sure you know the formula, isn't this? Year 2022 cash flow, and then we grow it by 1.06. We divide it by work minus G. In this case, our work was 11% and our G was 0. Okay, let's just say 6%. Right. So the terminal value, we add it to our 2022 cash flows, and then we discount the whole net cash flows by 11%. But how did you come up with this 11%? If you go to this note, after 2023, BHC's net flow is expected to grow by 3%, etc. And its normal work before considering benefits, synergistic benefits, is 13%, and the work is expected to fall to 11% after considering synergistic benefits. Our required asked us calculate the amount that should be paid for 60%. So if you calculate the amount that should be paid, we are looking for a maximum value, and a maximum value entails synergistic benefits. So we're going to take the work with 11%. Guys, this was a fairly easy question. I expected to get more than 100%. So make sure after we get we discount at 11%, right, to get our value of operations, and then we're going to add the investments in PP, and then less bless me, sorry, I have a terrible flu. And then we're going to less our debt here. After this, we get our enterprise value. So we wanted to acquire 60%. So if you say 60% times this amount, we get the total amount that should be paid in what? In pullers. This was in pullers. But we asked to calculate the amount in dollars. So if you're going to be using dollars, we're given this exchange rate. So if you apply it to the puller value that we get here, 1:10, then we get the amount that should be paid in dollars. So this was a fairly easy question, and I expected to get more than 50% students passing this exam. Another pitfall that most students did, some students converted their yearly cash flows, which likely stole time from them because it was unnecessary, and also the work that we are using is from Botswana, which means if we discount with 11% from Botswana, yet we are discounting dollar amounts, it was not going to be useful. What do we mean by this? We're saying for this amount that we're getting, let me just use a different color pen for these notes now. Okay, so we're saying for the amount that we're getting here, here, and here, and here, and here, some students were just converting these pool amounts to dollars each and every figure. So we can understand how tiresome it will be. And yet also we're going to use 11%, which is from Botswana. Thus, it was not helpful for you to use. It was not principally correct for you to use to convert the cash flows to dollars when you're going to use a discount rate from Botswana. So I hope you learned, guys, and I hope this revision was helpful for you. If you have any other issues, please feel free to visit the Manfin department. You can book a consult or use the WhatsApp platform, and we'll just address the issues there. Thank you so much for your time. Have a great day.